Alright, with the changing financial world, how do you invest? This is a question that I've had for quite some time now, because all of the ways I studied investing had to do with intrinsic values and undervaluation, and just generally value investing. But that has changed, and that strategy no longer works anymore. So how do you do it? Okay, well, first of all, what is value investing? Well, value investing is the system. As you can see, this is Warren Buffett right here. Value investing is the investment strategy where you find companies with low value or high value at a low price, right? So this means, let's say, um, you have a company called like Microsoft. It doesn't really matter which. And Microsoft, they have a share price of 200. I have no idea what their share price actually is, so let's just say it's $200, right? But the actual market price, what it should be, is more like $300, right? And the reason why it is not at $300 is, I don't know, it's undervalued. Um, Possible reasons could be there might have been a public scandal or some sort of lawsuit, something that made the public lose faith in the company. But overall, it didn't matter in the long run because Microsoft would succeed even with any public hardships. The best example of this is American Express and Warren Buffett, right? At some point, American Express experienced a huge dip in their stock. There was a huge scandal, and everybody thought the bank was going to go bankrupt. Now, instead of unloading all of Warren Buffett's shares, instead he analyzed the company and saw that in the end American Express would succeed. And with the low price that the stock was at, he could buy the stock at a discount before it recovered its value, right? And so then there's that concept of discount and intrinsic value. Intrinsic value is the true value of the stock. Now, a discount in this case means exactly what you think it is. The price of the stock is lower than what it should be, which means you can buy that stock at its low price and it will eventually recover, right? So you buy the discount, hold it until its intrinsic value, and then sell. Or you can just hold on to it longer. That's what Warren Buffett does. And to do this, you had to analyze the business. You had to look at their PE ratio, their PB ratio, just their business in general, if you want to figure out whether this company is undervalued or not, right? But this does not work to the same extent that it used to anymore. Why is this? Well, the changing financial world. Before we get into that, let's talk about what it is right now. Right now we have a multitude of speculative investments, hypothetical hype, monopolies, and competition eradication. Now let's start with speculative investments. So in this case, this concept is when the opposite happens, right? From what I was talking about before, discount versus intrinsic, right? This is talking about over-evaluation. Let's say the Microsoft stock once again should be valued at $300, but instead it's valued at $400, which means eventually the price is going to go down because the market will wake up and realize that Microsoft isn't actually worth $400, it's more worth $200. Now this leaves you an opportunity to, of course, short the stock, but because this has been happening so excessively across the entire market for so long and so much, it's very difficult to gauge when it's actually going to crash, right? And it hasn't really yet. Now, Here's the problem. With speculative investments, it all has to do with public sentiment and hype, right? And it's very hard to predict hype. You can look at it, and even when you do predict hype, when you look at the company versus their competition, it is very easy for the competition to now buy up these speculative businesses, right? And not only do they buy it up, or they will outcompete it, push it out of the circle. And this is done through monopolies. We have monopolies in today's world. Um, for example, look at Bear Stearns, right? That was a huge financial institution. What happened during the '08 financial crisis? JP Morgan Chase and companies bought it up, right? Even Bear Stearns couldn't exist or couldn't survive. So in today's world, we have huge monopolies. What does that mean? Well, it's harder on smaller businesses, which makes it harder for people to piggyback ride on the growth of new startups and new fresh businesses, which means their only investment choices are really the big monopolies that already exist, which show lower growth rates, right? So not only do monopolies prevent new businesses, it decreases the number of investment opportunities that are presented to an investor's lifetime. Okay, so what do you do about it? How do you invest today? Well, that's a little difficult. You can try to predict the hype. You can try to navigate this huge speculative market. But that takes a lot of time. And for a regular person like me who just wants to invest for retirement and savings, what do you do about it? Well, instead of piggyback riding on monopolies or trying to navigate the speculative market, which I fairly dislike, what you can do is instead buy an ETF, right? If we buy an ETF, right, some other financial institution, maybe like BlackRock, they own IYW, they're one of the largest financial institutions in the world, can buy their ETF, and that will grow, and they will manage your investment money for you with that ETF, and your investment money represents many different companies, right? But they manage which ones maintain portfolio dominance, right? You're basically buying a part of a portfolio that they own, which means they will manage it because they have a lot of time on their hands to do that, because that's what they do for a job, and you can trust them to grow your money through ETFs. However, the other part that I like is because of dividends. ETFs generally pay large or larger dividend amounts from compared to companies, because it's a collection of, well, companies, and most companies have, or a lot of companies have dividends, which means when you group them all together, you get a lot more dividends, right? And now, of course, you can buy dividend ETFs, such as SCHD, which pays 3% per month. That's an insane yield, which is great for compound interest. And it's great for retirement. And for retirement, you can put ETFs into a Roth IRA, never have to touch it again. You don't have to manage it. Why? Because it's an ETF, and they probably will not be going away anytime soon, just like SPY. So, that's it. One thing I forgot to mention is cryptocurrency. Do not invest in crypto. It is purely faith. People think it's some like new thing that is so insane and that's going to change the world. It's really not. The only way it's changing the world is that it's making climate change even worse. If you want a way to trade some sort of value that is not connected to the dollar and therefore the federal government. Use swaps, please. Just swap company stocks, or not company stocks, just stocks in general, because swaps, you can use them as currency, right? And you can actually base that money, that assets off of, it's a productive asset. That's the main thing. And cryptocurrency is non-productive, which means it's based on faith, just like the dollar. So in the end, it's just, you're putting a currency based on a currency. Sorry, a currency on a currency, right? Which doesn't change anything. It's just doubling down on the same thing that cryptocurrency is trying to solve, right? Or doubling down on the same problem that cryptocurrency is trying to solve. So yeah, ridiculous. Don't invest in that. But yeah, that's all for today's video. See ya.